Hey, hello there, and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. How are you today, Thomas Doty?
Life is good. Life is good.
I'm so glad to hear that, and I hope it remains that way. It's a great day, ladies and gentlemen. We have some great weather here in the Maryland areas, and just so glad to see everybody is tuning in. Hello around the United States of America and around the country, especially in the United Kingdom. Thank you for all you people up there in Scotland and England tuning in, and even my friends in Ireland. And I'm not going to forget you people in Wales who are great singers, the old lady too. So look, just want to let you know that's a little Welsh thing joke, though. So, so you all look, man. We had a wonderful topic last week, navigating volatile markets. We hope that helped you. This week, we're going to be talking about how to pick growth stocks. We've been talking about the stock market for a couple of years now. We've been talking about how it works, the benefits of it. But today we're going to dig down a little bit deeper to understand how to pick growth stocks, which are some of the most fastest growing stocks. But we know we've mentioned about the stock market, but we just want to give you a little bit more information for some of you who may think this is too much information. No, like we said, knowledge is power, you all. And it don't matter if you retired, you still got at least 15, 20 more years for your money to be working for you. So why not get the maximum out of your funds? Get the maximum return, the maximum performance. And one of the ways to do it is looking at growth stocks. And we're going to get into that today. And like I said, for some of you all who people sometimes, say, man, I don't know nothing about the market. And this is the time. This is the time because there's no more excuses for you not to be in it when so many people are making money, you all. I'm talking about average people. And there's a difference between compensation and passive income. Compensation is when you're working for your money. Passive income is when your money's working for you. And we just want to share that with you today. Dope, everything fine?
Life's good. Life is good.
Oh man, that's you got the right attitude. Attitude is everything. Appearance is just 80%. So don't let them fool you. So dope. Let's get with what the top of the topics that everybody always tell me they like to know what's going on with the stock market, especially if you have one of those 401k plans or any 403b or any kind of 401k plan out there. Let's delve into it, dope.
Okay, and it's been not a great week, not a bad week. The S&P, which is really considered the broad index because that's like 500 stocks, it had three losing days in a row. Fortunately, it eked out a gain today. And you can see for the week, it's pretty much flat or down just 31 points.
Better than being negative.
Huh? Oh, yeah. It's only a little negative. And the NASDAQ is kind of flat, too. It's up 41 points. But some of the stocks I hold did pretty good. Microsoft, which is my biggest holding, it's up 8 points for the week. The new stock I bought, Brady, is actually down. But again, I don't worry about what it does right now.
One more time for people who missed the show last week. What is Brady?
Brady is a company that's a manufacturing company that's global, and they make machinery and things that help other machines run more efficiently. And as we talk about how to pick growth stocks today, it's the same process I went through in picking the new stocks that I bought. And one was Brady.
I was going to ask you.
Yeah, so we'll go through that. My Apple stock is pretty much flat, but it's still doing well. Again, you look on that far right corner and see it's still up 20% year to date. HP is the other one I bought. It's down 2. My NVIDIA is up 4. And there's talk that it could go up another 40% because of the demand for their newest chip, which is, I think it's called the Blackwell. And the demand is off the chain. So I'm hoping that goes up very well. And that's the thing when we talk about picking stocks. You see, I have several stocks, but I got two real big winners, and in Microsoft and Nvidia, and those two cover a whole lot of ills. If you can just pick one winner, I mean, we know Nvidia is up over 10 times for me, and so you don't. Every stock you pick doesn't have to be a winner, but if you can get a good one every now and then, you're going to be okay. Google is pretty much flat, so this has been a pretty muted week. Not much has happened. There's some concern because the yield on the 10-year Treasury has been inching up, even though interest rates are going down. It seems like that doesn't make sense. But the 10-year is kind of looking at the whole what's going to happen kind of thing. And the yield has been inching up, and that's been kind of holding the stock market down. And one of the things that's making that happen is the Fed is kind of hinting that they may be a little more cautious with interest rate cuts. And so that's kind of making things long-term go up. So that's what's kind of holding the stock market down. But a lot of the earnings have been coming in good. And I typically don't look at stocks I sell, but I sold Tesla, I think it was last week. And that was because we said we're not going to be political, but I sold my Tesla anyway. And it announced.
Go ahead, you ain't dealing with that crazy fool. Go ahead and say it.
I ain't going to say that. But they've done really, really well. But again, you don't look back. You make a decision and you move forward. And
did you make out?
Oh, yeah, I ended up. I made money on it. But it's like I'm very optimistic on every stock I hold right now, and I still think I'm going to continue to do way better than the market's doing. So let's hope I do.
Well, Dope. Commodities are up. Gold is up and silver is up. Gold is now over $2,700 an ounce.
Yeah, I didn't check my gold fund, but for a while there, I was up 33% on that.
Yesterday, it went up $25 an ounce.
Oh, it's down today, though. My gold fund is down today.
Yeah, but it's still over $2,700 an ounce. It's only down by like $2. But like I said, the other day it was up $25. So it's only down $2 a day. That's a great net.
Well, I'm still up 29%.
Yeah, silver is up too. Silver is up to $33. It's interesting. Like we said, it's always good to have a balanced portfolio. And that's good. And my NXP, the semiconductor stocks, are still doing well, though. The SMCI, the Super Microcomputer Inc. That stock that split had 2 shares. It split to 20. It's doing good. It's up. So life is good in the stock market. Let's look at the cryptocurrency market. Dope.
I hope it's still going up.
Say it again.
I hope it's still going up.
Yeah, the total market cap is only up 11%, though, 26 billion. But the Bitcoin is up $862 compared to last week. That's up to 68,150 a Bitcoin. So some of you who were in there before 2020, you should be doing real well. Like me, I was before 2020. You too, right, Doe?
Oh, yeah.
So it's up 13%. Ethereum, the smart contract, is actually down 3%. I don't know what's going on with Ethereum, because they try to have a different platform which they process. And the whole thing about cryptocurrency, you all, it's because it's in cyberspace and it takes a lot of computer power to process these formulas because it's really it's a general ledger that is digital in the iCloud, and these things like companies like Ethereum are trying to find different ways to process these cryptocurrencies because it takes so much energy and power. And Ethereum is supposed to be a little bit better because they call it gas, how they calculate and use these computers, and they're supposed to have because they're smart contracts, supposed to be a little bit more efficient way to process these cryptocurrencies, but don't seem like they do. They're down $75, down 3%. That's not much. Then you got Tether, which has just been holding, and that is a stable coin which is pegged against the dollar, and it's up about $120 billion of Tether out there. Solana is up 19%. That's $28. It's at $178. And the Dogecoin, once again, the crazy man, Tesla man, who was trying to push Dogecoin and Mark Cuban, it's only at 14 cents, only up 1 cent. So remember, like we say, this is very highly speculative to be in cryptocurrency. There's several thousand cryptocurrencies out there. We try to stay within the top 10. Really, we stay within the top 1 because we really stay with Bitcoin. But, that's your choice. And I know people that made money in Shiba Inu, which is down totally. But, hey, hang in there. And remember, it's all about the long play, especially when you're talking about cryptocurrency. Please know that and understand that. All right, Dope. Let's get into our topic today, which is, how do you basically select a stock? But we're going to specifically be talking about growth stock. Why growth stock? I know y'all have heard this before, but let's delve into it, though, put a little bit more meat on the bones.
Yeah, and growth stocks, that's something I look at only because I know I can get a big return out of growth stocks. That's why I look at it. But the tough part is determining what they are and how do you find the best one. It's a lot easier to say it than it is to do it. Because if you think about it, every company's trying to grow, trying to grow their top line, trying to grow their profits. Some companies do and go like crazy when you think about the Microsofts of the world and NVIDIAs, and they grow consistently and constantly in big numbers and for a lot of years. Some can grow their top lines and their bottom lines consistently, but it's more modest. You think about a utility, which doesn't really grow that much, but it still provides, constant earnings. And so some go through cycles. You look at the automotive industry, it goes real well sometimes, and then sometimes it doesn't do so well when times are bad and people aren't buying cars and they have to start giving out big rebates to get people to buy cars. And then you think about some companies, they try to grow and they end up dying because they can't make it. And so you have all these type of companies. And so that makes, when you start talking about researching and looking for that specific growth company that you want, it's very, very difficult. And so what we're going to talk about today is how to look at growth stocks, what defines them, why investors look at them, and how you evaluate them to determine if it's something that you should get into.
And though the thing about, and I know a lot of people heard of growth stocks, especially if you got 401k plans or 403b plans. So you can have an individual stock, then you can have a growth fund. But we're going to talk about growth stocks. And when you hear us talking about them, you're going to learn about growth stocks, but then also look at them within a mutual fund or in a ETF or in a index fund. But one of the things about growth stocks, they are companies. Growth stocks are those companies that are considered to have potential to outperform the overall market over time because of their future potential. Value stocks are classified as companies that are currently trading below what they are really worth and will thus provide a superior return. So you always hear growth stocks versus value stocks. We're going to talk about that. But growth stocks can be found in small, mid, and large cap sectors and can only retain the status until the analysts feel that they have achieved their potential. Now, growth companies are considered to have a good chance for considerable expansion over the next few years. Now, either because they have a product or a line of products that are expected to sell well, or because they appear to be run better than many of their competitors, and thus they are predicted to gain and get an edge on their competitors in the market. That's like Doe said, almost all companies are like growth companies, growth stocks, but it depends on their philosophy. So let's get into it, Doe, a little bit better understanding.
Okay, first let's talk about why people are drawn to growth stocks. And the one to me, the major reason is the potential for great capital growth. Okay. They offer large capital gains, and the key or the ideal situation is if you recognize that company before it reaches its full market potential. And we've always talked about how capital gains are taxed much more favorably than regular income. The other reason is you're expecting above average growth. So they're going to go faster than the market. So instead of making that, we always talk about the S&P averaging 10%. If you got a growth stock, you're expecting to grow faster than that. I've already mentioned the tax advantages as far as capital gains, and a lot of times growth stocks don't pay a lot of dividends because they're putting all their money into growth. But really, you're looking for that capital gain. And finally, a lot of people get sucked into the brand loyalty. And that's like me. That's why I bought Apple stock, because I had an iPhone, iWatch, iPad, a HomePod, and I got AirPod Pros, and I got AirPod Maxes, AirPod Pro Max. So I'm thinking all of that stuff I got all work perfectly and seamlessly. And so I'm saying, this is a stock that I got to own it because I like the product so much. So those are some of the reasons people are drawn to growth stocks.
And it makes sense, though, if you're using the product, why not invest in your own product that you're using?
Exactly.
I tell the young people, what would you prefer have, Nikes or own a piece of the Nike company? But I just want to remind everybody, because, everybody is at different level. We got all ages on here and different levels of understanding out here. Just want to remind you that a lot of y'all, and even if you retired, you have money you may have money in growth stocks, in growth funds, like the TSP, Thrift Savings Plan, right? You got growth stocks, you got income balance funds, which is income and growth stocks. You got bond funds, you got value, the S fund, which is small cap. So we want to focus though on the growth stock, because those are the ones that seem to be most prevalent and could grow faster, but they are riskier than other investments, and they're not suitable for everybody, because a company may be recognized as a growth stock when it's already past its rapid growth period. Like some people, they maximized out to their growth potential. They're not creating any other products, and their products are being obsolete compared to other competitors. But there is rapid growth period that some companies actually, like I said, they pass their growth period and they stagnate. Another one is competition. New competitors may enter, like I said, a growing industry, which can hurt the original company's growth. Next one is the stock price swings. Growth stocks can experience larger price swings than other investment. And I'm sure y'all have seen that if anybody followed the TSP and look at the funds and the growth fund, the F fund, the G fund, the S fund, and international stock funds. They can swing a lot more greater. The next one is the difficulty identifying. It can be hard to identify a growth stock, meaning if a stock is actually growing. But this is what we're going to talk about today, some of the things that you can identify. Because growth investors are usually looking for companies that are expected to grow faster than others, and then they may reinvest the earnings into the company instead of paying dividends. They prefer to reinvest into the company to grow the company's products.
Yeah, and okay, so what are growth stocks? And please don't throw nothing at the computer, but growth stocks are stocks that are trying to grow. They exhibit growth characteristics. A lot of times it's speculative. A lot of times it's something that's new that hasn't caught on yet. Sometimes it is something that's caught on, but it's updated often enough that it continues to grow. And if you look at prospectuses for growth funds, this is the kind of verbiage that you'll see about growth stocks or growth funds, whether they're actively managed or ones that track an index. And depending on the fund, you may find different explanations of what a growth stock is.
So it's imperative to understand the most common growth metrics for growth funds. And one of them is revenue growth. I know y'all seen revenue before on the financials, and how rapidly revenue growth is, how rapidly is the company improving the rate at which it sells its products and or services. This is as simple as growth gets. You don't factor in any other lines on the income statement. You just look to see whether the money the company brings in is bigger than it was before.
That's for sure. Now, earnings growth is obviously very important when you look at a growth company. So you want to see how fast the company is improving its profits, earnings, net income, whatever the case may be. On the one hand, it's not the only measure, it's not a direct measure, because a lot of times when you grow, you may not always make money. So you have to look at other factors, things like how much is its cost of doing business? What are their operating expenses? Are they putting a lot of money into R&D? Are they putting a lot of money into marketing? Those are the kind of investments that you have to make in order to grow. And so you just can't look at earnings. And a lot of times you're speculating on what the acceptance of that product is going to be. So some of it is a gut feel to say, hey, this thing is going to take off, or it's put out there in a limited as a limited model, but you can see growth potential and you can see people reacting to it, and it can make you feel that this thing is going to take off. The example I always use, and I think I've mentioned it before, is Hoka shoes, Hoka tennis shoes. When my daughter told me about those things, she said, "Oh, Dad, they're the best shoes around. You should get you a pair." And I bought them and loved them and bought several pair. And when I go to the gym, I kept seeing everybody wearing them. And me and my son-in-law talked about buying the stock when it was about 200. I think it's over 600 now, but I never did. So that's one I missed. But those are the kind of things you look at when you're talking about a growth stock. And again, a lot of times those earnings can be reinvested to continue to grow or to up your growth speed, or it can be stashed away. And one of the things you'll see that growth companies will sometimes do, especially as they're growing rapidly and times may get a little tight, they may end up buying their stock back, which always increases the stock price. When there's less shares available, that's going to increase the stock price.
That's a very good point, though. Very good point. And about the revenue as far as the product lines that they have. I've given this example before. I want to share this example. When the iPhone first came out, the iPhone 7, right? Everybody was in a hoopla about, buying the iPhone. It's a good product. Apple's products were great. But what they didn't realize, though, the other thing was Apple did not make semiconductors which run phones. And Intel was the company that was in the iPhones, the first iPhones. So if you invested in Intel, you also would have been ahead of the game, because if the iPhones were selling, like cat wows, just think, if you had the semiconductor that's in the iPhones, you made money too. So that's the things when you look at the earnings, you look at the revenue. Another big one, though, and this is always an accounting one, it's called free cash flow, FCF, free cash flow growth. Speaking technically for a moment, net income is an accounting matrix, one that can be manipulated by all sorts of one-time events. Cash, though, I was always told this in accounting, follow the cash, because cash is dollar for dollar. You cannot have, netting off against, net income and all of these other things, like manipulating, the accounting on the financials. But cash, however, is real, tangible, in the now. Free cash flow is money left over after business pays its operating expenses and any capital expenditures. And some investors prefer to see growth in this matrix if they're looking at a growth stock, because unlike net income and to an extent even revenue, it can be easily skewed by accounting adjustment. But cash can't. Cash is cash, dollar for dollar. So that's why some people say follow the cash.
Yeah, another thing to look at is your net profit margin. And that explains how well a company can turn revenue into profits. Okay, that's looking at how much you make when you take your profits minus your revenue. And so a lot of things can affect that: pricing, the cost of what you make, how efficient your operations are, and other things. And it doesn't necessarily look at growth itself, but having a net high profit margin, that's going to lead to excess earnings. Okay, that can be plugged back into the company to key your growth and allow you to expand tremendously.
And here's another one, another growth stock matrix. And I'm sure you heard about this. ROE, return on equity, is another measurement of profitability. You calculate your REO by taking the company's net income and dividing it by the shareholders' equity. The general idea here is that the higher a company's return on equity, here is the better job the management is doing at turning equity financing into earnings. Not only do different investors favor different growth characteristics, but they might even favor different time elements. For instance, some funds will invest in stocks where, say, the past year's earnings, revenue, free cash flow growth exceeded certain thresholds. Others will only invest in stocks where long-term projections for earnings and revenue and free cash flow growth clear a certain bar. Now, some will continue. The two perhaps most demanding is holdings exceed a certain historical return on investment, while others require, a certain level of estimated earnings combined with revenue. Now, if you've heard the saying, past performance isn't an indicator of future returns, that goes for a company's operational results too. A company that grew revenue by 30% last year isn't guaranteed to grow it at all this year. And the past data can be flawed by, the way they evaluate the stocks. Could be a false or a way that they, or improper way they evaluated the stocks. So on the other hand, the estimates are clearly less concrete than actual results. Now, some professionals do their best to get the right companies, can and do not miss expectations. But past financial matrix that are other quality investors want to look at when evaluating growth stocks. This includes innovation, and disruptive products that are either better than those that currently exist, or products that define a new category and make other products obsolete. Like I said about that earlier, that can affect a person's growth in their company with the products they provide. So strong competitive positions, the unique value proposition that offers companies that can match. They got so many CEOs that are very visionaries and they're founders, and it all comes down to the management of that company.
Okay, so let's talk about growth stocks versus value stocks. And if you look at it, the U.S. stock market has over 12,000 publicly traded equities. And that's just too big for anybody to really try to analyze and find a good stock when you look at that many. So investors tend to look at sections of stocks and try to slice and dice them to get to a smaller number in order to pick from that smaller number. And if you look at one of the big divisions in stock that's usually reviewed is growth stocks and value stocks. Okay, make sure you understand they're not opposite. Value stocks are companies that the market believes are underappreciated, that they trade below some inherent measure of value, and you feel it's a bargain at a bargain price. Growth stocks, they usually, they're not the opposite. And a lot of times they're actually priced more than their value because a lot of their price is reflecting the fact that they may grow or they're expected to grow. So they're typically overvalued, okay? And so again, they're not opposites because you can find a growth stock that's undervalued. So please don't think they're opposite. They're just different, okay? And again, growth stocks are usually overpriced. And so a lot of times you'll pay more based on the pure value of a growth stock than you will for a value stock. And let me try to summarize the difference between those two. You want to pop that chart up, Bob?
Yes, yes. So
Okay. When you talk about the price, the value stock is typically undervalued and is priced lower than the broader market. Growth stocks are typically overvalued and priced higher than the broader market. Earnings, value stocks going to have low PE values, price earning values. Growth stocks going to have high earnings growth. The risk, value stocks are typically stable with very little volatility. Growth stocks, high risk, lots of volatility, and that fits into that no risk it, no biscuit. Dividends, value stocks going to typically pay you a high dividend because they don't have the big growth, so the money they make, they pass it on to their shareholders. Growth stocks, any excess money is usually used to continue to spur growth, or it's used to buy back stocks. So again, they're not opposites, they're just different. And one is obviously more risky than the others. I typically go for growth stocks. And again, when I talked about the process I used to pick the two stocks I just exchanged, these are some of the things I looked at.
yeah, that makes a lot of sense there. 'Cause a lot of people have asked me about value stocks. So, and it just depends on, which strategy you follow, how much risk you want to take. Now, why do investors, buy stocks? The answer is pretty straightforward. If the company is expected to grow its revenue, profits, and other metrics over time, then, it should be worth more over time, allowing investors to sell their stock for a better price down the road. Now, growth stocks, which in theory flourish at a faster pace than other equities, they have a potential to deliver a high degree of growth, a more rapid pace of growth, or even both, rapid pace and growth. And historically, though, growth stocks' performance is cyclical, experiencing years of outperformance versus value stocks, but also suffering year-long slumps compared to the cheaper brethren. Now, in short, there is a Harvard Fund. They had a white paper with a couple of examples that showed that growth stocks outperformed in the 90s during the dot-com era, had performed extremely well for more than a decade. Stocks outperformed, value stocks outperformed growth stocks from 2001 to 2008 as investors placed a greater value on dividends and stock valuations. Now, even during the most favorable periods for growth stocks, they still come with outsized risks, meaning they definitely have more risk than most other particular stocks. But they still come, they have, equity, especially, the equity can be determined by estimates of swift operational improvement. So a company can turn around rapidly right there within a time period. But should a company report substandard results and fall short of expectations, guess what? Investors might rapidly sell off the shares and begin seeking other great growth companies. That's the downside.
So how do you find the best growth stocks to buy? It sounds daunting, but it's really not. And for a lot of people who are afraid of risk, they can buy those large cap stock funds, through an EFT or through mutual funds. And that's going to reduce the risk because you're more diversified and you're going to have some ups and downs. But in those cases, you're kind of making the average. You're kind of doing average. But it lessens the risk. So if you're risk averse, that might be the way to go. But if you're willing to take a chance and you're risk tolerant and you're looking to generate some income that outperforms the market, then you might want to take a chance on looking for a growth stock. And if you can hit one or two, as I mentioned before, with, in my case, NVIDIA and Microsoft, and every stock I owned made money except for Pfizer. And so, but I had some that did tremendously well. And if you can hit a couple of those, you can outperform the market. You can do much better than the market, but it's a risky situation. So you got to be able, you have to be willing to accept the risk and do your analysis to make sure you pick a good growth stock. And if you do, and everything goes well, your performance will be tremendous.
And another best way to buy growth stocks is you can buy large cap stocks like those. Those are usually companies over, I think it's about, it's got to be like 500 million or up in bulk through ETFs, electronic trade funds, or mutual funds. Now, indeed, more risk-adverse investors would do well to do that because it can lessen the chances that disaster in one or two equities will destroy the significant portion of your portfolio. That's, why we say mutual funds, you don't put all your eggs in one basket. But a stock, growth stock, you just have one stock, and that's like putting all your eggs in one basket. But that stock can grow, But if you're risk tolerant and looking to generate some outperformance in your portfolio, concentrated investments in one or a couple of individual stocks, like what Dope does, will do the job more effectively.
Yeah, so and if you're trying to screen, if you look at the S&P 1500, that's going to include the S&P 500, which is mostly large companies, the S&P Mid Cap 400, mid cap, medium size, and the S&P Small Cap 600, small companies. So that's where you start your search. And so if you're looking for real growth, you might want to start with the large and the mid cap as well as some of the larger small cap stocks. And so you might want to do an analysis and say, show me everything with estimated earnings per share growth rate of at least 15%. So you look at every stock that has that kind of growth rate, and that's where you start deciding which one you want to pick. Okay. These estimates, you got to realize that's no guarantee. They are just estimates. And so if you're setting this high bar, you're looking for everything that's growing at least 15%. You have to understand things could happen to make that not happen. But also things can happen that can make those earnings estimates much higher than that 15%. But that just might be one slice you might do to lower that huge number of stocks to just look at stocks with a very, very healthy growth rate.
Very good advice, though. And just to continue, one method is, to have at least, look at 10 analysts, 10 different analysts. You can go out there and Google, look at stocks that are on Wall Street's analyst radar, which makes it likelier that there's both more reporting and more insights on these companies when you look at it on, Wall Street analysts. And the more research you have at your disposal, the more educated decision you can make, especially if you're using like about, on average, 10 analysts that are analyzing stocks. And with a consensus buy rating, all of the stock must have an average broker recommendation. Some people mark it at 2.5 or less with an S&P Global Marketing Scale. So S&P Global Marketing Scale actually converts ratings into numerical skill. So when you go out there, you can look at an S&P market, the global market, Google it, and anything with a score of 2.5 or less is considered a buy. Now, every stock that made the list has a score of at least 1.5 or less, which considers a strong buy when it's down that low. Now, the highest designation, meaning that some analysts consider stocks to buy, it's like a 1.5. So if you're looking for another way to look at stocks, like I said, you look at these analysts, look at a consensus rating, and they usually have a rating of 2.5 that's considered a buy. Lower the rating, the more strong it is a buy, the higher the rating, the less it is of a buy. And sometimes it go into just a hold, or sometimes it's go into a sell mode. But that's just some of the things to consider when you're looking at, basic qualities and looking at stocks. And we hope that actually help you, because we know it's a lot of information. Like I said, a bunch of you all who are in retirement plans, who are retired, don't think that you can just stay conservative, because remember, inflation eats through your money, taxes eats through your money, and $1 today is not worth $1 tomorrow. So the name of the game to me and Doe, why are we so strong about the stock market? Because we believe in that you need to maximize the return on your money. The money just sitting in a savings account earning less than 1%. That is not growing wealth. And we do know we're going to get older and things are going to cost. And I hope you plan to live a more enjoyable life and just don't sit back on your earnings and enjoy life. So we just wanted to talk a little bit about that today. So, Doe, with that.
And before you do, Bob, you can go to any of the big brokerage companies, Fidelity, E-Trade, Schwab, TD America, any of those, and you can look at the stocks that their analysts are rating very, very high, or the strong buys. And that can be where you start. And then you can do a little more analysis to look at the numbers and see if that's a company that you might be interested in buying. But all firms offer that information for free. And you can look at different industries, different segments, different regions of the world in order to help you decide what kind of stock you want to buy.
And we're not saying take your money and shift it all into growth stocks. No, we always talk about diversification, having a balanced portfolio. And growth stocks is one way to do that, especially if you just, and our saying, no risk it, no biscuit. And if you take on a little bit more risk, and we're not talking about sell the farm, sell your house, sell your kids. We're just talking about trying to maximize the performance of the money that you have. So with that, Dope, let's go to the takeaways for today.
Okay, and you've kind of led right into that with your last statement. Our first takeaway is where is it? Oh, I thought that was it. Here we go. Growth stocks have a place in your portfolio. Again, depending on your risk level, if you are risk tolerant like myself, you're going to have more growth stocks. You're going to look for more growth stocks. If you're more risk averse like Bob, you may have less growth stocks in your portfolio. But you should have some, because again, if you can hit on one, it's going to make your whole portfolio performance much, much better. So find a place in your portfolio to get you a few growth stocks in there.
And y'all have heard me and Doe's model. No risk it, no biscuit. Just sometimes it just takes just a little bit more risk to get a greater return. Now, growth stocks, though, are like going for a home run, right? Because it's just one stock. That stock go down, then, so goes the farm. Different than ETFs and mutual funds and index funds. Trying to get, the outliers, that one product that, everybody missed, but everybody won. It can grow fast. Growth stocks can grow faster, but at a much more risk is involved. Like I said, it's like putting all your eggs in one basket.
Next, we have understand the risk. Understand the downside. Understand that you're betting on greater than market growth. And so there's a chance that it may not hit those numbers. It may end up falling short of the expected growth, in which case it won't grow at the rate you expected. And so it probably won't do as well. And that's going to happen from time to time. But do your analysis, get something strong with a strong recommendation, your chances of increase of being successful. But you have to understand the risk. Understand that you are taking a chance. You're trying to hit that home run. And sometimes when you're trying to hit that home run, you strike out.
And lastly, picking a stock requires analysis. We talked about some of the matrix that you can look at. We talked about, some of the things that you need to consider and when you're looking at stocks. And then push come to shove, you can always, go to the advisor, but it takes work. It takes effort. Nothing is just going to be given to you. But if you put the effort in, I'm telling you, you can actually, really, really increase your wealth and also your generational wealth just by taking on a little bit more risk and understanding, though, what you're getting into, whether it's growth stocks, whether it's growth and income stocks, whether it's small cap international stocks or bonds. You must understand, and that's what we're just trying to provide with you all today, is provide you with a better understanding so that you can make, advised and informed decisions. So with that dope, another great show. We come to the end. I'd like to give a shout out to all our people, Modestine, Carl Chapman, Joanne Skinner, my sister Linda. I don't know where Nolia and Gloria is today, but I'm going to get on them. Modestine, she said it's 87 degrees in Lexington, South Carolina. Go ahead, girl. And now Edwards Doty, Rodney L. Madison Sr., TheNoteExperience.com. It's always a pleasure having you on board, my brother. And the wonderful Deborah Doty.
Hey, Dee.
We got the Doty family out here. Joanne, so glad you're with us. And Modestine, thank you. She said, thank you for sharing some of the ratios to analyze picking stocks. You are so welcome. This is our 172nd show, dope. We just rolling right along. Like I told y'all before, please, if you have some topics you'd like for us to discuss, research for you, put it in the comment box. Matter of fact, we like for you when you put more things in the comment box because that helps us get more algorithms and we can reach more people. But, okay, thanks, Linda. She said Nolia and Gloria are tied up. Oh, I hope that it ain't no kinky stuff. But anyway, just want to say thank you to everybody tuning in. Dope. Where's phone, Dope? I just want to say, Dope, I want to leave you with the quote of the day. And this is an original one. This is new by the Big Bobster. A ship is supposed to take you someplace, like a relationship, a partnership, a leadership, fellowship, a mentorship, a friendship, though. If none of these ships are going anywhere, you need to abandon ship. So with that, have a wonderful, wonderful week, ladies and gentlemen. And we'll see you here next week. Thank you all and have a great week.